All right. Hey, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for the first Monday in February, the 7th. I changed my comment, and this one comes from Will Smith. It's I've never viewed myself as particularly talented, where I excel's ridiculous, sickening work ethic. You know, while the other guy's sleeping, I put playing in there. I'm working, and that was from Will Smith. And I brought that out because two questions that were emailed to me this week, especially since we're getting a bunch of new of the Jeffrey Dunyan safe option strategy students here. A couple people have asked me, well, I want to do what you're doing. I've taken some education. I think I'm okay. So I'm going to give you the short and skinny of what it takes to what I'm doing. To answer it for the couple people here that are, well, that have brought up and asked me, hey, I kind of want to do what you're doing. So a couple points that I just wanted to bring out that got me to where I'm at. Number one, you probably will spend about $65K in education. And those will be everything from spread trade systems to optionetics to invest tools to spread tarde. I love that one. Thank you. I think those are actually spelled right. To safe option strategies to what's the guy? What is the guy? The option Wade Cook. Glad to see him going through. So that's kind of your route for education. What do you think I found out about education? What do you guys think? What do you think I found out about education? Okay, well, I'm going to put that one in here. Most are BS, if that's okay to call it that way. There you go. Mata is really looking for that one. Most education results are based on paper trading, no risk, right? Russ said it really good. Only works in a perfect world. Love the way you said that, Russ. That is absolutely ideal. There are a couple other that are there. I love that one too. A poor guy teaching you how to be rich. And then I love that one too. And I'm just going to put annualized fake returns, which usually equal, right? One big win annualized to a fake return. I agree. But somewhere along the line, you realize, all right, it doesn't work. Optionetics. So you've got to find what works, right? Now, there are a couple other things that it takes. You have to be licensed, bonded, and insured, which for me, it meant basically I was working 50 hours a week and studying 16 other hours. That's kind of how I made my ends meet, right? Course first year, expect only 30 to 40% of your committed money to actually come over. That was the big one. What I thought originally had coming over to me, 30% came over. It was just ridiculous. And then you've got it, then there's a question. Then when you've made it, right? Track record, leads coming in. The big question is, do you still work? I know in my industry, it means people get lazy. It means people don't still work. It's the market's fault. You want to know why people aren't doing what I'm doing? It's too much work. People don't care. It's actually your guys' fault. Yeah, people don't care. I just put them in something. I put them in a fund. Work is how to churn you out of one fund into another. Work is, well, market's up, market's down today. Am I going to answer my phone? It's pretty interesting because for me, work means being up at around 6 a.m. Mountain Standard Time to read market news. And my day ends at 2 p.m. The last month, it's kind of wicked. Last month, watching that Asian markets open up at 2 a.m. to see the after lunch open and the European opens to try to find out where our market may go. Well, Kevin, 6:30 to 2, that's what? 7:30, 8:30, 9:30, 10:30, 11:30, 12:30, 1:30. It's only 7.5 hours. For me, you usually finish at 4 p.m. and continue to read work numbers, prepare for webinars, right? The good thing is, though, Friday, 2 p.m., my week ends until Sunday evening. And that's how I run it. To get licensed, bonded, insured, usually costs you about $25,000. And if you're smart, you'll have a law firm that's going to be on retainer for you. And it's your way to make sure that you're prepared for people that shouldn't be in the market. That's kind of the base of what it kind of takes to do this. What I'm not telling you right now you should trade all the different disciplines that are out there, which means you should do Forex. You should trade commodities. You should trade metals. You should trade stocks, funds, ETF, futures, options. If you're not doing this, you don't know what's out there. If you never traded for pips, 6 pips, you're not there. Day trading, artificial intelligence trading. What was the other one that I was going to do? Swaps are a big one, but that's not what I'm looking at. I'm looking at, crying out loud, completely. Just brain fart. It was just right there and I missed it. But it's these type of trading that if you haven't done it, you don't know what's out there. Forex, a better way to say it, Jim, we'll call it Forex that way. It's currency trading. It's playing the yen against the dollar, against the pound, against the German, Brazilian real, something like that. And ADP just said, all you need to be good is one strategy that work in most market environments, two at most if you want some adrenaline. I agree. But until you've traded Forex, until you've day traded, until you've done these other ones, you lack the experience to understand what people go through and where the errors are. I've done all these. Had some good runs. What's the main part of it? Comes down to it's not working, because I've heard this a little bit here recently. You need a proven methodology that can work over time. Now, there's a couple things you need to be told. A couple things that are different than education. Average returns are a farce. They do not equal profitability. They never have. You know what equals profitability? Portfolio growth. Dollar cost averaging without having to put more money into your account. Collar trading, because it allows me to be wrong on the direction of a stock. I don't have to be right. It just has to go up or down. It just can't stay sideways. We made the comment before, right, about Ford. Ford was 3.5 years till you popped off a 400% return or 500% return. $3.5 years of gathering shares. Some of us are sitting in the same thing right now with Boeing. And we might be sitting in the same thing with Facebook here. But I found a video that I'm going to show to you twice. And I want you to go ahead and watch this twice. I found it very interesting. I'm pretty sure you guys are going to be able to hear it. All right, so did we have sound for that? No sound. All right, let's try this one more time. Of course there's no sound. So how about now? Do we have sound now?
There has been a decades-long effort to change how we think about our investments.
Yes, can you guys hear it now?
Performance your investments generate, you should accept.
All right, let me try that again. Here we go. Let's make sure you guys can hear this one.
Some people should not own stocks at all because they just get.
Okay, here we go.
People should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. Not own stocks at all because they just.
I'm going to play that one more time for you.
Just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated.
All right. Give me your thoughts on that. What are your thoughts on Warren Buffett's belief? So I'm going to read 3 of them because I love it. And so if I'm okay, I'm going to use your comment, and William, I'm going to use your comment too. I'm not emotionally or psychologically fit for life, but I trust you to do this because I am less fit to manage stocks. And William said, right on. Emotionally, I can't handle managing my retirement. A couple I concurs. I know people are not fit to trade stocks. let's face it, some people should not be in the stock market. It's too tough. So, what do we do at Hurley Investments? It's a little different. Every Monday night, we're trying to show you what we see, what we're doing, and why. We're not trying to educate you to do this on your own. In fact, for most of you, my honest answer now is that there's no reason you need to stay with us. If you don't like what's happening or the way your stock's being managed, the way your portfolio is being managed, it's a free country. Go ahead and go for it. Well, Kevin, that's pretty damn rude. Yep, it is. The hard truth, if it's too tough watching what you do, what we do, it's a free country. You're welcome to go where you want. With that said, some of you though are saying, you know what, Kevin, I like what you bring to the table. And it's funny, I just saw Mike here today. A couple people asked me here recently, and it's probably going back a month. They're like, why are you guys in Apple? You have been in Apple for like forever. And it's interesting because about 3 or 4 weeks ago, I thought I went through with everyone. For those that are new, you need to go to myhurleyinvestment.com. And I've got a picture of, I don't know what it is. I've got one where I worked all the numbers on where the stocks that are our core holdings, where they can get to. But someone asked me recently, well, Kevin, why are you in Apple? You've been in Apple for so long. It's run its run. It's overvalued. We believe in the Warren Buffett system of buying in a company that's going to be much better off 10 years from now than in where it is today. This is a chart based on the Apple filings. I went through their filings for the third quarter of 2021. It's spot on. Total revenue, 81.4 billion. Total services revenue is 17.15. And they broke it out. The products revenue, 39.6 billion in iPhones, 8.2 billion in Macs, 1.7 billion in iPads. Wearables and accessories, 8.8 billion. And I really like the cost of the products. To make it all, it costs 40.9 billion. The products gross margin for iPhones and Macs and iPads and wearables, 23 billion profit. That's why we're an Apple. The services for one quarter was $17.5 billion. The cost of running the services, having the servers and the iCloud and all the money they put into it, 5.3 billion. They grossed $12.2 billion on their services. 70% margin. Well, Kevin, they're coming at the expense of screwing over the programmers. Well, I kind of disagree. The programmers can go to other places, but it is expensive if you're going to market on Apple. They will take a third of your profits. What's the difference? And this is where people don't get it. I would go on Apple in a heartbeat. If I'm not on Apple, the numbers right now are showing that you can get 5 times as many customers on Apple as you can on Google for an app. Apple gets you 5 times as many customers. Let's do the math. If it cost you 10% of every $100,000 you make, right? On Google, you're going to end up with 90K. If you give up 35% on Apple, but you have 5 times as many customers, let's do the math. 500,000 times 0.065, because 35% you give away, that gives you $325,000 of revenue. Same product, same advertising. Out of curiosity, where would you rather advertise your product at? Would you rather do it on Google? Or would you rather do it on Apple? Well, think about it, right? This should be a no-brainer. No-brainer on where you should go. So I'm going to ask this group, where would you advertise? Google at a 10%? Or should you advertise on Apple and pay the 35%? Right? Well, it's funny. 2 people just said as a programmer, Apple, of course. But you got to pay 35% for your advertising versus 10. Well, Kevin, I don't want to give 35% of my profits. Yeah, but if you only give up 10, you only make 90 grand. Why wouldn't you pay for the advertiser that can get you 5 times the amount of clients? I'd pay 35% for advertising if it gets me 5 times the amount. 90,000 versus 325,000. It's a no-brainer. But Kevin, what if it doesn't work? There's the catch again, right? What if it doesn't work? And the interesting thought on that one is, it works, but not necessarily on our timetable. That's the interesting part. I'm going to talk about Disney. Disney has its earnings on Wednesday. Disney in 2019 was the king of the box office market share. It ran 38% of the market for movies in 2019. And its core business is theme parks. So it's not even its core business. And it ran 38% of the market share of movies. And it's going to do better this year because it teamed up and it had, Spider-Man or whatever it was, knocked it out of the park. The cash cow for Disney, just like Apple services, is the movies. And Disney is at $142.51 today, when it's traded as high as 208. Let's do the math. It's traded as high as 208. That might be intraday. It might have closed at 205. 142 and 51 cents, right? People are asking me all the time, why am I in Disney? Well, again, everything I do is simple numbers. Disney has an upside this year alone, just getting back to where it's traded, of $65.49. You take 142.51, divide it by 65.49. Actually, divide it by 65.49 divided by 142.51. It has a 45.9% upside return on investment. That is why we are in Disney. Will it come this year? I don't know. I think movies are coming back. I think people are going back to the movies. They're going back to eat. They should be going back to the theme parks. Unfortunately, one's in California. Only state in the world where you can have a life-threatening emergency pandemic, shut down all the businesses, but still hold the Super Bowl there, right? Way to go, California. Grew up there, glad I moved out. If it just for kicks and giggles, just as a small division, just at a small expense, own 38% of the market share in 2019 of the box office, Disney's going to be off to the races. As we look at accounts, we do have some other long puts, but if you take a look down below here, pretty amazing day, right? Disney makes some money, and our protection that should be losing money was up today because of volatility. Way to go, Disney. We make money to the upside and to the downside. But our options are at 150. So it's going to be in our best interest to move this down to 145 or even find a 142.50. Kevin, why wouldn't you put those puts in the money? Well, right now they've got a profit to them. Let me go ahead and run this up a little bit. They've got a profit to them. I just grabbed a couple here, right? Our cost basis of $77.34.89 has a gain of $7,302. The problem with these 150 puts is it has like a 0.9, maybe a 0.8. I don't know what the delta is, but it has a high delta that if Disney has good earnings and moves up to 150, we won't make anything on Disney because of the protection, because of the insurance. We're going to give up this profit. So, due to the methodology, we're going to roll that protection down to at the money, which means tomorrow it's my job to find 142.50s or 145 long puts and it's time to cash in that profit. It's time to give us upside potential without giving it away by overpaying for that protection. So I've got to roll it down to as close to at the money, as close to $140.50 as possible. Well, Kevin, what if it goes down? Well, if it goes down, we're going to make, we'd make 7,300 a booked profit, and we're going to have new protection at 142. Wouldn't it be better just to keep it in place? No. Because if we run up $7.50 plus the cost of the puts is $7.50, you don't make anything on the next $15 higher. No, we don't want to keep it in place. But what if Disney goes down? Well, then we would want to keep it in place, but you don't roll the dice. You don't try to outguess the market. You don't gamble away a $7,300 profit. You book the money. You book your profits. For us, we're talking about 70 some odd $1,000, if not more. To take a quick peek at what we can do, though, there are a lot of you that are in Facebook right now. And we did a little something different to Facebook. Although I think I might have a couple questions here. Yes, Abraham, we're going to book that intrinsic profit, the in the money value, and correct, just leave that extrinsic or extra value. For Facebook today, rather interesting. Facebook was down. I'm going to use the yellow highlighter. Facebook was down 41,000. And our puts today only made up $40,630. We missed the downward movement on Facebook today. Let me tell you how much Facebook lost. I got to grab it from a different chart. Facebook, wow. Facebook lost $12.18 on 3,400 shares. Facebook today lost 41,000. We made up 40,630. But because it broke some supports, there are 10 of you that have Facebook, one of you that has twice as many shares as everyone else. We actually added today, when Facebook was down about $8, one more option. We added one more option on Facebook at that $230 range. Kind of neat today. We made up an additional $5,747.50. Now it's just one day. But when was the last time a stock lost 5.14% and your broker said, hey, we're doing okay. Your account could be down $41,412, but we're actually up $46,377 today. When a stock that's down 5.14%, today you made up more on the way down than the stock lost. You know what's really getting pretty neat? This value is almost half of this value. These puts that expire on February 25th, if that shoots up, if the value of the stock goes down and this shoots up to like 365, 370, we're going to pick up 50% more shares of stock. Kevin, when is Facebook going to return? I don't know. The methodology of color trading is not to outguess the stock market. I don't know, but it doesn't matter. If you pick up 50% more shares of stock and Facebook gets back up to break even, you're going to be looking at 150% return. You will be okay. Facebook will probably get all the way down to 200. Right now, after hours, Facebook is down to 222.75. It's lost another $2.16. It will probably go down to somewhere around 200. It's a round number. It was an old level support. Boy, if we can keep making money on the way down, we might look at adding 80% more shares of stock. 80% more shares of stock without asking you once to put more money into your account. Could we have done better last year? Probably. But this is what we're doing. This is the ability to get those ridiculous returns like we had in 2020 because a couple things came back. I really liked the big picture. Please read through the big picture. I think you'll find it extremely interesting. Changes coming, interest rates, blah, 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 but I highlighted what I really liked. In brief, one should be looking to buy quality companies at a reasonable price as opposed to buying unprofitable companies at any price. Right now, we have some companies that are considered cheap. This little drop is hitting technology. This little drop is actually really going to hit materials, but I don't know if it's going to materials because of higher interest rates. It's hitting housing. That's not going to be really good. Energy should be good. Higher interest rates. Energy is a great safe haven. But right now, to look at quality companies that are at a much more reasonable price than they were a month ago, as opposed to buying unprofitable companies at any price, our market just gave us the opportunity to buy some great stocks on sale for cheap or cheaper. Disney's one of them. Two big ones coming up, Ford and Under Armour. Both down 35 and like 38%. Great opportunities. I kind of giggle because there's some of you that are out there. The store has a fire sale and everything goes on sale for cheap. And people run out of the stock market. Blows me away. Welcome to inexperience. Not trading everything, not being there, not willing to learn. Fire sale on stock, 10% in a month. S&P was down almost 10% in January, and people go running out of the market. Thank goodness we have puts. We can cash in some profit. We can possibly add some shares. I do give the Y charts here. You can click on that to see that information. As I was looking at the Dow is still bearish. And if you were to bring Bollinger Bands, those Bollinger Bands are tightening. We have a difference between the 50-day and the 200-day. Roughly they are, what, 90 points? 90 points on the Dow separate the 200-day from the 50-day. If there are Bollinger Bands that are pinch, we're going to have a breakout one way, up or down. That's going to be the question. If you take a look at the S&P 500, Little bit better. It's going to be 127 points away. But those same Bollinger Bands starting to pinch, you would see it exactly the same way. In fact, I'm going to go ahead and I'm going to throw out a quick poll question. You're going to get a new screen that's going to pop up. Should pop up. Where's that poll question? Select poll question. There we go. Give me a quick idea. Where do you think the S&P 500 will be at the end of February? Right now, it's currently trading at 4,483. So where will the S&P 500 trade February? Right now, it's currently trading at 4,483. About half of you voted. I'm going to give you just a couple more minutes. Where are we going to see the S&P 500 trade? It's currently trading at 4,483. Will it be at 48.15, 4,700, 46.14, 44.40, or 42.19? Going to give you 5 more seconds. All you got to do is click on the little circle there. 5, 4, 3, 2, 1. All right, I'm going to close it. Pretty interesting. There were the results. Most of you think we're going to go up and touch that 46.14. We're going to go 127 points higher, which I would also think that's where we're going to head up to. We're probably going to head up to the 46.14. But where do I think we're going to end the month? I'm going to be a fan of 44.40. So my answer would be 44.40. That's where I think we are going to be. Kevin, why or how did you come up with those numbers? Well, it's pretty simple. Here's your 48.15 at your R1 resistance level right up above. 4,700 is just a round number. 46.14 is the 50-day simple moving average, your blue line. 4,400 is the 200-day simple moving average, and the S1 support level, which is a standard deviation down at 42.19. That's how I came up with those numbers. It's interesting because the question was, where do we think it's going to end? If I share it one more time with you, I think we're going to probably have to test the 200-day again. And we broke the 200-day. We broke right through it and stayed down there for a week. I think we'll test it after we touch the 46.14 because there's a bunch of sell orders stacked up by institutional traders. Institutional traders are going to have those sell orders stacked up at the 50-day, right? So because of that, we got to be careful. I'm probably going to add or adjust protection, maybe add a second set up by that 50-day. Because more often than not, we're going to come and touch that 440. We're going to retest the lows. It'll be a double bottom. What gives me so much confidence? A rate hike in March. You know what would be amazing? if inflation and fear postpone a rate hike till June. That gives us a run that you sell in May and go away. We'd have March, April, half of March, April, and May for things to head back up. Then you're probably going to put that protection on. That's what I'm looking at, and that's what I'm seeing right now. And it's not rocket science. I didn't arbitrarily pick those numbers. I'm using simple technical analysis that we're taught in the beginning levels of any education. It's amazing how many people skip technical analysis, fundamental analysis, sentimental analysis. They don't know how to run valuations for companies. Spend 25 grand on education, boom. Forget the foundation of all your choices. You follow some dummy that gives you a weird percent return. Stupid. Do your own work. Don't take a cool chart of Apple and say, hey, it looks pretty. Do your own work to know where it's going and what you should be doing. Spend your time understanding the numbers. Look at the NASDAQ, it's still bearish. And we're not even at the 200-day yet. We're probably going to keep protection on a little bit longer. I talked about February being down 3%. That'll fall pretty close in line with the 4,440 finishing in April. Earnings, I've listed quite a few in there. They're pretty exciting. Amgen today, Tuesday, DuPont, BP, Pfizer is in there. Lyft, Peloton, Yum China. Wednesday, CVS. I'm probably going to run, I'm going to run CVS with out of the money puts. They should be doing pretty good. You have DraftKings, you have Yum, Disney's after the close on Wednesday. Disney has some pretty easy numbers to beat. They should do okay. They just have to have some growth in Disney Plus. Thursday, Duke Energy, cyber something, one of Kathy Wood's CyberArk, CYBR, cyber something is that I'm going to pay attention to. Kellogg's, Twitter, GoDaddy, Yelp, Coke on Thursday. Probably going to go with some $60 out of the money puts there. Coke should start doing better. People are back at stores. They get the products out. Be an interesting one to pay attention to. Friday, we have all right, I'm back. Sorry about that. I hit something. Friday, we have Dominion and Under Armour, Goodyear tires. I'm going to pay attention to, obviously, Under Armour. I'm hoping to roll our protection that's everywhere from 18, 1850, 19 up to 20. Consumer credit today was not at $25 billion, only came in at $18.9 billion. People are still charging up their cards for January. I like the number. We have the trade balance, wholesale inventories, really inflation, CPI and PPI, Michigan sentiment. Economic reports are pretty low. We're really going to be going with general macro events that are coming up, and we're going to go with earnings. That's what's going to move our market this week. Last week, we saw what bellwethers did. Someone asked me, Kevin, what really is a bellwether stock? Apple, Facebook, Amazon, Google. Duh. You just look at last week, up, down, up, down. Bellwether stocks are stocks that move markets. I'm shocked. I'm absolutely shocked that a bellwether stock like Facebook, which truly is not a bellwether stock, Meta, right? It doesn't have the numbers to be a bellwether stock. Take a look at it. It's only $627 billion. There's quite a few companies that are much higher than market cap than Facebook. Book to share is high over on the left. Sales is only $117 billion. Pretty interesting. Cash per share is at 17. Short float just got above 1%. A lot of profit margin there. No debt to equity. Pretty interesting. I would call Facebook a bellwether stock. Has it earned it fundamentally? No, but it moves our markets. All right, we already saw that one. Let me keep going down a little bit more. I found an interesting article on explaining the steering volatility of individual stocks and indexes and what it's signaling. If you want to know what's causing our volatility, this is the article for you to read. I agree with it all. Really interesting on where they hit on a bunch of different things. Pay attention to it. Pay attention to it. Obviously, you can't fight the Fed. People are trying to finally learn that. Pay attention and go through and read where we're looking at. I like the fact that they had GDP in here. We're probably going to have a much lower GDP than the expected, 3.5% or 4%? Watch GDP numbers come down. Very interesting article on Ford. It's a buying opportunity right now. Great revenues, great returns, great 200,000 orders for the Lightning. And now they're not taking any more orders. People have to drop out for new people to come back on. Go through and read the article on how Ford is really doing. It's in a chip crunch. Warren Buffett's long-term focus pays off again as Berkshire Hathaway passes Meta Platforms in value. I love it. I absolutely love that the system that we're following is right now 1, 2, 3, 4, 5, 6 on the chart of most profitable companies. Run by a bunch of 80 and 90-year-olds right now. Who's to say there's not something for experience, right? Another 320 million stolen on cryptocurrency. Gone, disappeared. Goodbye. They're not going to see that money back again. Why people are investing in a black market, easily stolen, easily hidden transaction? I wonder. 320 million gone. Over 12.6 or 8 billion in cryptocurrencies disappeared. Almost $13 billion of cryptocurrency is gone that people will never get back again. It's not protected by SIPC, FDIC. It's not protected by errors and emissions. Almost $13 billion of cryptocurrency is gone. People will never see it. It will never go back in their account. Yet people are rolling the dice and putting every penny they have into it. I'm not a big fan of AOC, right? I think she's an idiot. But you got to give her credit. AOC is saying, hey, it's no mystery why it's hard to ban lawmakers from stock trading. She obviously has no money in the stock market. But look at her saying, hey, there are people that got briefed on COVID that sold a bunch of stock off before a big market fall. Too bad more people aren't doing it in a blind trust like Trump did or like Really, the biggest one was Mitt Romney. Credit to Mitt Romney. I'm not a fan of him, but he runs everything in a blind trust. He doesn't make decisions on what's happening in the stock market. Kudos to someone that's taking it pretty good, being pretty honest. All right, guys, questions. I've got about 6 minutes before I go run a kid to a soccer practice up in Salt Lake. Questions. What questions do you guys have that I can do the best I can to get them answered for you? If there are no questions, just tell me good night and we'll call it a night. But if there are questions, please let me know. Are you without puts when no earnings event? So Howard, sometimes on Apple I'm without puts, on Bank of America I'm without puts. I'm going to say this very politely because it goes against Jeffrey Dunion's belief. If you are always have puts on your stock and the short calls, you can't make money. You've capped your upside. Even if you got 2 years, you only have about 3 earnings events. Your stock would have to move on average over 36% to be profitable if you always had puts on. So I go back, Howard, to simple technical analysis. If the stock is bullish, I'm not running puts on a bullish running stock. Plain and simple. It's really easy to understand. The trend is your friend. So I'm not going to put a bearish position on a bullish moving stock. With that said, we have Facebook forward covered right now. Yes, I'm protecting those as they go down because they're bearish. But the simple answer is on bullish moving stocks, I'm not putting a bearish position on, especially after earnings if they have a run. But I will put it on for events. And we're going to have protective puts on all the events for a March. How did I say it? The March Fed rate meeting. Not usually. What else? Netflix long term. Ida, Netflix is kind of blowing it. Netflix probably going to continue to go down. Howard, let's talk when I get the paperwork in. Netflix not looking good, Ida. Netflix is one that when you're really looking at things, Netflix is going to struggle. And if I had it my way, look at flat net. Well, that's not fair because they're really at 402. They're up at 720. If I was going to make a prediction on Netflix, because their numbers are not really good at all and they're losing market share, I would expect Netflix to go down and touch the 250 level. And that's where I think it's going to meander for a while. So 250 is the ugh. Where's Baidu going to go? I love that. SoFi was selling off their Alibaba, and on a day like today where Netflix owns 35% Alibaba, I don't remember how much it is. I loved seeing Baidu down 278 versus a 750, primarily because I've got puts on Baidu, right? If you were to ask me where Baidu is going to go, it won't get back up to 380 this year, but it could with all the ARK investments and new money going in. If you were to ask me, Baidu, where's it going to go? It's had good earnings. I would most likely think Baidu could get back into that 260 or 280 range. But Baidu is definitely close to doing a double this year. Easy numbers to beat. Still were profitable. they've gotten through their issues with the government. Baidu can be a 260 to 280, if not $300 stock this year. Their earnings validate it. All right, guys. Hey, pleasure having you. Howard, I have not heard from the other Howard yet, but don't hesitate to send them my way. And guys, pleasure being with you tonight. I'm going to run. Got to get his kid to soccer practice. I will get this posted with the help of Dave Westlake sometime tomorrow, early tomorrow, and love it. You guys have a good evening. I will see you again on Thursday. Kiva's gone this week. Kiva is putting some good time at Disneyland and helping boost that stock up. Guys, have a good evening. I will talk to you on Thursday morning. Have a good night. Bye-bye.